We should be live now. Okay. Guys, welcome. Todd Gordon, founder of Trading Analysis. I do apologize profusely for being late. This was nothing short of a I don't know, a tech bonanza. Trading and market analysis, especially in volatility, is actually easier than running all the multimedia and stuff that goes behind a trading and analysis multimedia business. So, all right, guys, so welcome. If you hung in there, appreciate it. Again, I'm Todd Gordon, founder of TradingAnalysis.com. This is a pop-up live analysis session here. What a great day to do it with unbelievable CPI, reversal back, crazy volatility. Figured we would tell you, just take you through the way we're seeing the markets, introduce you to the trade analysis team. Let me bring those guys in right now. Boys, gentlemen, happy CPI day.
Greetings, Todd. Good afternoon. How you doing?
I've been better. I was going to say the trading, I don't know if you guys heard the intro, the trading and the analysis part is easy when you're running a trade analysis business. It's the rest of this crap that's in there.
It's the tech that sometimes gets you. I can relate, man. I get it.
I mean, I give you credit. You running this every week. I haven't done this in a while, but no, we got a fresh kind of outlook for you guys. So again, we'll take you through the trading analysis team. We'll give you a little bit of history here. And I know you guys are viewing on the trade analysis website, so it's I know the questions are hidden, which is not ideal. We'd like to communicate with you as possible, but let me just take you through the team here quickly. As I said, it's just unbelievable response to a CPI, long inflation spike after a dormant period, and we're just trying to figure out which way is up. So, opening comments, guys, as we kind of gather our breath here, and what are you seeing?
It's been quite the volatile move. What's interesting is if we take a step back and look at the indexes, our initial downside target in the S&P was 34.69 to 34.74, somewhere in that range.
Yeah.
And following today's 34.91 low, I mean, we've seen 150 plus points back to the upside. So I actually think, and we were discussing this with clients today, I actually think it's entirely possible, and call me crazy, but I think it's possible we may have completed at least 5 waves down from August. So things could get interesting going into the midterms.
Yeah, we have a lot to show you guys, a lot to show you, a lot to introduce you to, and hopefully some of you are new and don't know the trade analysis team. Let me put the proper splash screen up here. Look at this.
Oh, no volume.
No volume on that one. Yep, that's okay. They can hear me. But anyways, so what I thought I'd do is just take you around the circle here and introduce you to the trade analysis team. Give you a little history, on what we've done.
Screen up here.
And then kind of give you our best 4 ideas, how to take you into the end of the year, the way we're positioning our portfolios and our trading accounts, and the way we're advising our clients. So hopefully you'll get a good taste of the way we approach the markets, especially in volatile periods right now, which I think takes a lot of flexibility to go from a very low volatility environment that just seemed to go up forever in 2015, 16, 17, 18 to volatility, mean reversion. Vol has come back with a vengeance, and macro relationships are changing, and the way you're going to be, the time frames you're going to be trading, and perhaps the instruments that you're trading might be different, because there's a lot of different things filtering into this market. So we have a lot to show you. Let me. Oh, bless you.
Bless you.
Yeah. So let's start off. Bennett Tyndall is essentially my right-hand man at Trading Analysis. He's been running the business the last 2 years as I've stepped away from the business. So Bennett let me just bring up Bennett's slide here, and I'll let him take you through. He's been instrumental in running all aspects of the business. He's got a very interesting sort of background, professionally speaking, before he came to work for trading analysis. He likes to hang out in the skies quite a bit. He's a pilot. He's a network engineer. He built me this awesome computer that can handle all these different tasks that we have to do. Excellent in Elliott wave analysis and trading. So I'm going to turn it over to Bennett, let him talk a little bit about where he's coming from and what he brings to trading analysis. So Bennett, take it away.
Sounds good. Appreciate it, Todd. Just making sure we have audio here. I do think we should be good, but just in case, if there's anybody out there, let me know if there are any other technical difficulties. So let's jump into it here. I today felt it would be appropriate, given the move that we saw following CPI, to kind of take a step back and put the 2022 correction into context. So we're going to look a lot at the hard right edge of the chart, but just a bit about my background. Before coming to trading analysis, I actually started my career in network and systems administration, graduated college from California. So I'm originally on the West Coast, made the move here to Texas about 5 years ago. In addition to obviously financial markets, my hobbies include aviation, as Todd mentioned. Been a licensed private pilot for, I believe, six years now. Time flies. And then other hobbies of interest obviously includes anything tech, anything RF communication related, and then of course firearms. You got to enjoy firearms here in Texas. So hopefully I'm not offending anybody with that. All right, so if you could bring up my screen share. I will. I don't have a way to control the slides you've got there.
Bennett, are you able to see as I'm sharing? Are you able to see what screen I'm sharing? Because
partially, yeah. My camera unfortunately blocks most of it.
Okay, so yeah, let me just walk you guys through this.
We lost your audio now.
Okay, hang on one second. So yeah, so I'm going to bring this up here. Number 2, your role at TA. Tell people a little bit about what you do, and I'll make some adjustments so you can hear me. And what you can do is, if you can see the screen, that'd be great. Follow along, because I'm going to have everybody go through and sort of introduce yourself in terms of that document you filled out for me.
Yep, sounds good. All right, so yeah, here at Trading Analysis, and I've been actually with Todd now for 3 years. I can't believe we're approaching like 1 month away from 3 years since Todd began his journey into wealth management. But I originally joined Todd on the premier side of the business, focusing on stock and options. And part of my day-to-day here at Trading Analysis includes guiding our clients through the volatility of the markets. And we have been doing that using a combination of Elliott wave and Fibonacci now for almost a decade. We're approaching our 10-year anniversary here. I've been with Todd for a third of that approximately. So looking forward to what the next 10 years brings. But through the past 3 years, we have noticed some changes within the markets that we feel are best analyzed using the hard right edge of the chart. Obviously, we live in a world with constant information flow, and it can often be difficult to squelch the noise and focus on what matters. And we've seen a lot of mixed opinions across the financial industry, and it can often be difficult. So I focus on the hard right edge using a combination of Elliott wave, Fibonacci, and intramarket analysis. And I've been trading for actually more than 10 years. I had put 10 years in the bio. I started trading shortly out of college, around 22, 23. I'm now 37 years old. And as far as how I approach the markets 2 different ways. Obviously, given the fact I am many years from retirement, I continue to utilize strategies such as dollar cost averaging in both my traditional and Roth IRAs. And then in addition to that, I take anywhere from 20 to 30% of my total investable assets, and that's focused mostly on index option tradings with our clients here at Trading Analysis. And we do so obviously using Elliott wave and Fibonacci, and now more recently, relative rotation graph analysis, which Terry's going to take you through as well. And for today, I'm going to take you guys through the S&P. I think with the move up, it's of importance and of significance.
Yep. Yeah, thanks for that intro, and I'll pop you in here. Screen share is going to be yours, and just reinforce again the way you kind of oversee the day-to-day operations here. And Bennett kind of, he's the ultimate decider right now in terms of the trades that are going on and our biases in the markets. And I think it's important to know that we have a very much a sort of a round table discussion. We debate market directions all the time because I feel like there's no formulaic way to approach the market. So we really I tried to set the tone 10 years ago that let's have an open forum debate. If you feel the market's going up, the other guy feels it's going down, that's great. That's what makes a market. So I really want to encourage that, bring each guy's respective talents and interests in the way he likes to apply our foundation. But every guy's got a little bit different way to paint, with a little technique to paint the masterpiece. So Bennett, I'll throw a screen share to you and share what you are seeing in this insane day. Bennett, this is coming to you in 1 second. Okay. Bennett, you screen sharing right now, bud?
Yes, sir. Ready to go.
Okay. Stand by 1 sec. I don't think also, go into just a little bit more detail before you do. I don't think we covered, you have kind of a dual approach to your portfolios. So you said you're only 37. Talk about like how you handle longer term positions and your shorter term capital right now, especially as market's down 30% from the highs. Talk to us about that a little bit if you don't mind.
Yep, not a problem.
That means right now.
Oh, sorry. I thought you were throwing the screen share in my direction. I was waiting on your screen share hand up. Yeah, definitely. And speaking of markets, 3650 handle in the SPX after us south of the 3500 handle this morning. Quite interesting. Yeah, to your point, Todd, I think it's difficult right now, especially in this market when you have a lot of headlines coming at you. It's difficult for traders and investors to kind of separate their classifications of thinking, if you would, and kind of compartmentalize the difference between your longer term investments and your shorter term trading accounts. And what I've used and have done using Elliott Wave and Fibonacci still is take advantage of the major lows and the major highs within the indexes. Occasionally, I will take advantage of, let's say, Wave 5 extremes to perhaps sell some premium. But more importantly, I feel that a lot of people kind of miss the target in terms of how they can take advantage of and welcome volatility such as we see here in 2022. Depending on your time to retirement, moves like this you should absolutely welcome. But it can be difficult, we've found, for clients to be continuing to remain long in their retirement accounts while maintaining a short position, let's say a directional short position in the indexes on a shorter term basis. And I've got the screen share. Yep.
Nice. So you have screen share go, and you're ready to go, and you want to kind of take us through what you're seeing here?
Yeah, definitely. I've got a few slides put together just to give some examples as to how we've used Elliott Wave in the past and how we can use it to not only trend forecast but manage risk as well.
Okay, perfect. Here you go. Screen is yours.
All right, sounds good. So let's jump into it here. I can adjust for that. That's easy. So what we're looking at here, and let's see, Todd, maybe I can zoom my end. Let's see here. I can adjust my screen share perhaps. Yep, I'm good. Okay, so let's jump into here. As Todd mentioned, we've got a full team here at Trading Analysis, obviously focusing on not only stock and options, but the cryptocurrency markets, which Alex is going to kind of take you through here in just a bit. A bit about myself, some additional background. Chief analyst here at tradinganalysis.com, full-time trader and investor. Started trading shortly out of college at around 22. Originally got my start in network and systems administration. And yep, we're good on audio. Originally got my start in network and systems administration, but fell in love with the markets very early in life. My grandfather was a fairly active and avid self-directed investor, and I still have memories from when I was, 6 and 7 years old, watching him work his handwritten spreadsheets and copying down data from the ticker tape coming over the television. So it's amazing how much things have changed and the amount of information that we have access to at our fingertips. So as mentioned, I do currently head up and have for the past 3 years been in charge of the premier side of the business, which is the stock and options side. And as part of my responsibilities here at Trading Analysis, in addition to covering intraday market commentary with our clients, we deliver our nightly analysis and a strategy video update. This is every Sunday through Thursday evening. And as you can see here, we ended up covering the S&P, the NASDAQ, Russell 2000 small caps, Dow Jones. And then, of course, we also move into the various sectors and then a macro coverage. So let's get into what I'm here to talk about today, and that is our approach to analyzing markets. And we all have a bit of a different approach. However, they tend to kind of meet somewhere in the middle. And what I mean by that is this. With the recent addition of relative rotation graph analysis, which is something Julius de Kempner came up with and has licensed to various platforms, including Optima, StockCharts.com. I believe the Bloomberg terminal even now has a license for it. With the introduction of relative rotation graph analysis, which Terry's going to take you through here in just a bit, we have found kind of a new component to how we analyze and scan markets. And what this has done for us is it's given us the ability to run a quant scan, if you would, across various sectors and indexes, looking for certain conditions and criteria to be met. So, for example, if we're looking for stocks that are outperforming the benchmark index, we're obviously looking for stocks that are obviously demonstrating either increasing relative strength and momentum, or they're already demonstrating leading strength and momentum compared to the benchmark. And what we can do with that is then narrow it down to a list that is then analyzed using discretionary analysis. And that's where Elliott Wave and Fibonacci comes into the picture. And from there, we're able to identify our risk and establish our objectives. And for those of you who don't know what Elliott Wave is, perhaps, I'll quickly take you through a breakdown of that. It's simply a form of technical analysis that we use to identify patterns that exist and, more importantly, repeat in financial markets. And unlike traditional technical indicators, Elliott Wave is predictive. It is forward-looking as opposed to traditional indicators, which are by design lagging and reactive and need price action developments. So in the world of Elliott Wave, each pattern includes a set of rules and guidelines. And this is important because as I will show you in just a few moments, we can use these, quote, trend invalidation or trend confirmation levels to not only determine direction of trend, but to narrow and define risk. And we're going to show you how we've used that successfully this year in the indexes and how well I think we've made a solid move up from the lows today. There is still the possibility rather, that we do in fact push right back towards the south. So why is this important? Well, obviously, when it comes to trading and hard right edge analysis, it's important to understand whether you are in a trending market that's moving from the bottom left to the top right-hand corner of your screen, or whether or not you're in a corrective environment, such as how gold has traded mostly sideways for the past 10 plus years. And when it comes to Elliott Wave, there are only two classifications of developments. We have trend establishing developments, which are referred to as motive sequences. Motive sequences start trends, and motive sequences end trends. And then in between those, you're going to find your corrective waves. If you're not at all familiar with Elliott Wave and you're interested perhaps in who on earth and who came up with the wave principle, that's none other than R.N. Elliott, or Ralph Nelson Elliott, born 1871. He actually began his career as an accountant specializing in railroad build-outs throughout Mexico and South America. In 1924, he was commissioned by the U.S. State Department to be the chief accountant of Nicaragua. A short time later, unfortunately, he became sick. He was confined to his home, and that's when he began studying the 1932 book Dow Theory. That's where he discovered that financial markets trend in reverse in recognizable patterns, and he compiled his observations in what is now known as the wave principle. So more importantly, how do we use Elliott Wave, and why is it important in the current market environment? Well, we use Elliott Wave to not only trend forecast, but we also use Elliott Wave to manage risk. And as I will show you here in this example, you can see the chart of AMD. We were looking for an upside bid towards 92. And as you can see in the next chart, that is essentially equated to 4.29% of assumed downside risk in the stock for potentially 13.2% of upside reward. That's not taking into consideration an options trade. This is just the stock itself. And as you can see, the breakout did occur. Here's another example of using Elliott Wave, in this case, not to manage risk, but to trend forecast. And this takes us back to the summer of 2019, where we had been trading in a sideways period of consolidation in the market indexes. And as you can see on this chart, we had identified what appeared to be sideways consolidation, and we're looking for a breakout towards 3,300, at which point the hard right edge of the chart, the Elliott Wave pattern development, suggested that that top, that high in the market, would yield at least 3 waves down back towards the December 2018 lows. This chart was put together in the summer of 2019. So Elliott Wave saw the coronavirus decline on the chart before coronavirus was even a thing or even known to be a thing. And as you can see in the next chart, we met a high of 33.93, and we ended up with a very sharp decline, ultimately breaking the December of 2018 lows. I'll show you why that's important in just a minute. And then here's another quick example using the stock of Tesla. So we've gone from the S&P to now Tesla. Here we can identify resistance, and Elliott Wave suggested that resistance would be offered near 786, expecting a decline from there. And as you can see, we met resistance in green Y of blue B and proceeded to sell off then in 5 waves. And then more recently, in April of 21, Alex had identified what appeared to be a completed third wave top in Bitcoin near 60,000. He was looking for a move down to 18 to 22 by as early as January of this year and as late as June. And if you've been following cryptocurrency markets, you obviously know what's happened there. Here's a view of the next chart. A 55% decline followed. Now, here's one from August of this year. And if you're subscribed to the Trading Analysis mailing list, then you are well aware of the progression that we entered off of the August 16th area high. And here now is an example of using those key decision levels, or quote, trend validation or invalidation levels. And what we had essentially established coming off of the August 16th area high was a level at 39.45.86 in the SPX. So what this suggested when viewing the market through the lens of the Elliott Wave principle is that in the event the S&P were to break south of 39.45, it would automatically open the door to 36.36. That would be downside target number 1. And as you can see here in the next chart, we broke right through 39.45.86, and we have since moved south of the June area low. Now, why does this matter? Well, it matters because the financial media has been wrong for years. Allow me to show you a few examples with actually not recent headlines, and this just further illustrates the point. This veteran analyst here's echoes of the 1929 crash in today's stock market. This was published October 5th of 21. Let's take a look at the next one. A 47-year market vet explains why he sees the economy's supercycle hurtling towards depression and lays out his case for an 80% plunge later this year. You notice anything strange about that last article? It was posted in April of 2020. What was the market doing in April of 2020? Let's take a look. April of 2020, we had seen a better than 50% retracement of the decline, the coronavirus decline. And right here on the chart is when the collective financial media, or a good majority of the collective financial media, was suggesting an 80% haircut was imminent. And if you take a look at the next chart, we can see instead of selling off 80%, the S&P ended up rallying to the tune of 70 plus just from April of 2020. So fortunately, thanks to the hard right edge using Elliott Wave as our guide, we were able to not only see that decline coming, but we saw that coming well in advance. So as you can clearly see, many very intelligent investors have missed out on sizable returns due to the market uncertainties. And I frankly think it's about to happen again. And I see now the second most important market decision of the year on the horizon. And we're here to help guide you through that market decision. taking a look at where we are now today in the S&P, and I'm going to expand my screen share here, looking at the chart of the S&P 500, in the event of a break under 39.45, as we looked at earlier and as we brought to your attention in August, we would be looking for a move down to 34.69. That was our initial downside target in the event we broke 36.36, which we in fact did. Now, today's opening low in the S&P was 34.91 spot 58. As you can see, that is just above the 34.69 spot 36 1272 fib target. We're going to talk about the significance of that here in just a moment. Now, before continuing on, I am not dismissing the more bearish scenario that does exist as a possibility. And you've probably seen this chart floating around the market somewhere. This chart overlays the 2008 decline on current price action. And as you can see, the similarities are certainly striking. But this does not equate to an all-out bear market. And is this time different or is this time not different? We can't yet answer that question. However, we do feel the question will be answered over the next 3 to 4 weeks in the market indexes. And we're going to show you how we can help guide you through that decision and what you need to be watching for and the key decision levels along the way. Now, it's entirely possible that we are entering a more significant bear market. I will not dismiss that possibility, but I will instead look for evidence before ever considering adopting that as a preferred interpretation. For now, it is very difficult to justify, from a macro perspective, a decline such as what we saw in 2008. But here could, in fact, be the similarities between them. On the left side, I have now the 2022 decline, and on the right-hand side, we have in red the 2008 decline. And as you can see, the overall trend wave has been fairly similar in that we can identify an initial 5-wave decline, a sharp retracement, which was our summer rally. Here for the 2008 decline, we see that same 5-wave sequence and a sharp retracement. And now we've pushed 5 waves back to the low, just as we did in 2008. And it looks as if we are at least entering 3 waves back to the upside, which is why I feel is actually finally upon us. The first market decision came in August. We walked you through that. If you were a member of or subscribed to our mailing list, we walked you through that and provided you with the key decision levels. And so now I want to take you through what the preferred interpretation would be and what the more bearish alternate interpretation would be in the event we see markets continue back to the south. So first of all, taking a step back and looking at the daily chart of the S&P 500 going all the way back to September of 2018, we can see a 3-wave sell-off concluding December of 2018. Now, thanks to the guideline of equality, which is taught within the Elliott Wave principle, we knew that the December 2018 low was likely not all of the correction. The reason it was likely not all of the correction is that the wave count, the hard right edge, the pattern developments in financial markets that repeat, that are consistent, suggested that we were seeing a corrective sequence that would be more or less equal to the corrective sequence between April of 2010 and October of 2011. And that guideline of equality can be demonstrated in either duration of correction or magnitude of correction. So in this case, if we were to move this green 4th wave over to the low on December of 2018, it would be so short in both price and time that it would be very difficult to justify that as the end of the corrective wave. Which is why, zooming back in on the daily correction weekly chart with the September 29.41 spot 9.1 intraday high on the top left here, or middle left, from that 3-wave decline, that is exactly why in the chart that I showed you earlier, we had the S&P 500 mapped out as coming out of December of 2018 as up in a 5-wave trend establishing a higher degree sequence, a sideways triangle consolidation, and that's the chart that we showed you that was suggesting a move to 3,300 was upon us. Now, we had this mapped out as the wave 4 being a triangle, meaning we would have 3 down, 3 up, another 3 down, another 3 up, another 3 down, and then the correction would be over. The coronavirus came along and set the social mood up such that a decline, a more impulsive and directional decline, was in store. And that's exactly what occurred going into the March 2020 low, which, by the way, speaking of the guideline of equality regarding corrections of the same degree, let's take a look at, before moving on, that wave 4 compared to the April 2010 through October 2011 decline. Looking at the time comparison, and thanks to the trading analysis edition of the MotiveWave platform, I can quickly do that with a keystroke. Time elapsed in wave 2, zooming in, was about 2 weeks off of being exactly equal to time elapsed in wave 4. So this tells me as an Elliotician that that low is in fact wave 4 of the cycle degree trend from the credit crisis low in 2009. Now, here's where things at Trading Analysis are different from perhaps what you may have seen across the Elliott Wave space. There are many who are labeling the January 2022 high as this green cycle degree wave 5. That's important because that would imply from the credit crisis low that we do in fact have 5 waves up complete, and that we are about to enter a more significant retracement of this upside advance. Now, we have a bit of a different approach, and we feel that markets are still trading in that cycle degree wave 5, and that we are simply trading out waves 1 and 2 of that 5th wave. Now, zooming in on current developments, and we'll go off the weekly down to the daily. Down on the daily chart, we can identify from January through June a 5-wave leading contracting variety diagonal. Yes, wave 3 did exceed the 100% relationship to wave 1, which typically, per the rules and guidelines of the Elliott Wave principle, would be would call for perhaps a recount. My justification for labeling this a leading contracting variety diagonal is due to the fact that in the NASDAQ, the Russell 2000, the Dow Jones Industrial, it is entirely valid to call the January or November high through the June low as a motive trend. So that's important because that implies that we had 3 waves up into August of 22, which, by the way, August of 22, we were able to use this same methodology on a 5 and 10 minute time frame to put a short position to work with clients about 1 hour before the reversal occurred on August 16th. Now, from August 16th, we have a move down in wave 1, up in 2, down in 3, up in 4, and down in 5, with today's low yielding a now 150 plus point rally. So it's entirely possible that with today's gap down and markets trading better than 2.27% from yesterday's close, and then almost 5+% off of the low, it's entirely possible that the 2022 correction is over. And Alex is going to show you, I believe, a chart of the US dollar index, which would also help to substantiate this possibility. Now, this chart will need to prove itself, and that will be with now a trend wave up and a corrective retracement. In the event we are able to see a trend wave up and a corrective retracement, it would open up opportunities on the long side that I feel many traders and investors are simply not anticipating. Alternatively, if in fact the comparison of 2008 to now is of any significance, that would imply that we are preparing to retrace in 3 waves into the midterms. And if this is the wave count, we have significantly more work to do on the downside. I remain impartial at this point, given the fact there are many variables that could ignite either one of these scenarios, which is why it's very important that we continue to analyze the validity of the trend, look for those trend waves, look for those invalidation levels, just as we gave you with 39.45 in the S&P back in coming off of the August high, which set up new lows. In the event we see 3 up, it's time to get risk off. But if this market can continue to deliver the uptrend that we have started today we will be looking much higher in the S&P. Now, two ideas that I want to leave you with. Number one, the chart of AMD. Looking to the chart of AMD, if we are to see a more significant upside reversal out of the market, AMD, and believe it or not, the semiconductor industry group would be one industry group that I would consider trading long into, in that I see this as a significant wave 4 with support between 50 and 54. So this is one we will send you in the follow-up email, and then you probably saw this one yesterday, but I wanted to bring this one to your attention as well. The stock of Netflix has seen increasing strength and momentum relative to the communications sector, which implies one of two things. Either the decline in Netflix has been more mature and ahead of the communications sector, or the rally that we've seen in shares of Netflix is simply corrective. Now, for the time being, this is holding up quite well. We have what can be a trend establishing mode of development. Remember, mode of development start trends and they end trends. We have a potential trend establishing mode of development underway. And if this chart continues to deliver in 5 waves, a 3-wave retracement will set up upside continuation in a name that has been out of favor for quite some time. Whereas alternatively, just as I showed you in the S&P in August, if Netflix and this market does in fact turn back to the south, this will probably be the most straightforward short opportunity out there. In the event Netflix breaks south of 207.38, it's going back to the lows, in my opinion. Under 207.38, not only will it go likely back to 162, we could be on our way to 120 to 125. So AMD and Netflix, either side of the scenario, depending on how things progress out of the next 2 to 3 weeks, which I feel will be of most significance. So that's it from me. That's my view currently in the market. I do feel that we are up against a major decision, given the fact that the downside support zone has responded. We'll be taking this one wave at a time with our clients.
Nice work there, Bennett. Everyone's head spinning on that one. Bennett gets very detailed. He's our resident Elliott Wave, call it neurosurgeon. But yeah, it's unbelievable, unbelievable move back out of that wave 5. So, you know, it's interesting. What I'm looking at your chart here is let me just flash it back here real quick. The 5-wave move down there, if it is all of C, the time it took was only what? 2 months or so compared to coming off of the very top. I mean, it's been a very short C wave where A wave would have been a lot more labored. But talk about like probably peak bearishness and sentiment at, you know, just probably horrible levels right now following this bad CPI report. It would just be the market's sick and twisted way to reverse when people least expect it.
Exactly. And to your point, regarding time elapsed in that C wave decline, it is very short. It comes in less than 38% of time elapsed in the January through June decline. However, as you know, the parallel corrective channel, the 1272 fib, there's a confluence of technical support in that zone that could be of significance. So you can see the blue corrective trend channel, which one of the telltale signs of Elliott wave corrections are, for those of you who don't know, corrective moves will often be contained within parallel trend lines. So from the high in January through the high in August with your parallel trend line over the low of the A wave, that helps you to shore up the 1272 fib near 3450 to 3500. Now, if you're going to be applying channeling techniques such as this on log scale, make sure you are not changing time frames. Draw it to the time frame you're on. If you change time frames, you're going to see that skewed. So just a heads up for anybody out there interested.
Nice work. Yeah, I'll at the end of the presentation, I have. I'm going to go at the end. I'm going to put the trade analysis team here in front. I've got something that I'd like to show you guys longer term, a little bit more simple. Outlook on where the market is, and if those of you who are new, if this seemed to be, speaking in tongues, if this is a new language, I could say, don't worry. There is a learning curve. It's not impossible, and in fact, the learning curve is shorter than you think if you put some time and effort into it. I have clients. I have customers over the last 10 years of trade analysis who came to us on a trial. Could barely put an Elliott Wave label or understand the concepts and the corrections and all that, and then within 3 months or 6 months, they're doing work that I would feature up in our daily videos or consider putting on for a trade. I've seen people. There's two of the guys right here on the screen who were clients. I watched their work. I watched it progress to the point where, like, okay, Bennett's better than this than I am. I've been doing Elliott Wave for 20 years now, and there's it's been around since the late 30s. Early 40s, I think, is when it first began. But these guys, it's better than I am now, and it can be learned. It's you just have to see enough analysis that will call turning points in the market that no other analysis or methodology can call. And I've got a story I'll tell you when I go, but you just have to see it work enough. It's the only true leading indicator with technical analysis that I know of. Everything else, as far as I'm concerned, is a lagging indicator, but it requires you to open your mind and think a little bit outside the box. Anybody want to? Yep.
No, I was going to say, very well said, Todd. And to your point, it can be confusing at first. A lot of people have a tendency to approach it with, perhaps glazed eyes, which is why we, every evening, Sunday through Thursday evening, will walk our clients through the key decision levels. So you don't have to understand what the wave labels mean to take advantage of the risk management aspect and trend forecasting abilities of Elliott Wave. So we try to do a really good job of guiding our clients through the key decision levels, such as the 3945 level that we had there in the SPX.
Yeah, for sure. Terry, do you want to? I'm going to bring you in next. Is there anything you want to add on top of that Elliott Wave discussion?
No, I think Bennett is the resident expert for sure, and I follow his work with great interest. But you're going to get into what I do next, and I'm hoping that the viewers see that what I'm doing right now is kind of a supplement to what we need here at Trading Analysis. Is digging through all the stocks in the market and understanding the relationship of price patterns within those stocks relative to the benchmark S&P.
Yeah.
Right. So while Bennett has the forecast on where the S&P is going, we also need to be working in the background, identifying those stocks and sectors and industry groups in the market that have the best chance of success for whatever trading plans that we're putting together, because there's just thousands of instruments out there to mess with, and if they all move together like today, when everything is moving together, how do you filter through that? So that's what I've kind of been working as a research director here for Todd for the last couple of years doing this. So we'll get into that here in a moment.
You're about as close to our quant. I mean, we're really a discretionary trading organization, but you're about as close to our quant as it gets. Terry is crunching some pretty good data. I'll bring up his bio. You can see where he's coming from. Pretty impressive career and background, and but that's the whole point. Is Elliott Wave is really meant to be applied to the stock indexes. And R.N. Elliott was charting on his porch in his house in Mexico in the latter years of his life hourly closes of the Dow Jones Industrial Average, and really the Elliott Wave principle is designed to track the ebbs and flows and the human emotion that is inevitable as humans are trying to discount where the markets are going to go in the future in reaction to the data that came out today or they expect to happen to come out down the line. So it's always good to have an idea of where you are in the market, bullish or bearish, and have a couple different interpretations based on this methodology. And then as Terry will go into, filter down and find the different macro markets, which we all do, and more so Alex's department, but where the macro flow is going, which is very important, with everything the interest rates are doing and commodities and currencies. And then we go down to the sector level and find the sectors that are under or outperform the index, then go down to the industries, and then go to the stocks and find the stocks to trade, which is really where Terry and I focus. So it all comes together very nicely. With that said, let me bring in Professor Spin Doctor Terry Long. He's been with us for coming up about 4 years now. Terry, formerly a client, he'll take you through his bio here. Love having him on the team, kind of our voice of reason, keep us all moving forward here. So Terry, I'm going to send you the bio screen and take it away right now. Tell us a little bit about yourself.
All right. Okay, so with a degree in chemical engineering, I had a successful 34-year career with ExxonMobil, variety of engineering assignments in the petrochemical industry. Now, while planning for my retirement, I knew that I wanted to do something interesting in that retirement. I knew I had a passion for technical analysis. I mean, I've been invested in the market since the 90s and really haven't applied strict or even had the time to understand it, but I knew I wanted to do it. It was kind of the same kind of things I was doing at the chemical plant, but more advanced things here with the stock market. So I started following trading analysis back in 2016. I became an avid subscriber and listened intently for every video that Todd would put out, because for years maybe I had attempted to look at Elliott Wave and there just really didn't understand it. I saw him using this MotiveWave product, and I said, "Holy cow, that's it. That's what I need to learn." Right. So in 2017, I retired from ExxonMobil. I began pursuing my continued education with Todd Gordon's classes on Fibonacci, Elliott Wave, and option trading, and I applied that skill, I guess, to a point where I pestered Todd enough with questions that in 2018 I joined the trading analysis team as a MotiveWave analyst. So what do you think about that, Todd? I mean, when was I pestering you
I
with
don't think
commentary too
no,
much?
no, I don't think you pestered. I think it's not. I don't want to say it in a bad way. I think Bennett gets the award for the most tenacity for getting for coming in. Bennett was hammering me with content. Terry,
Persistence.
Persistency for sure. I mean, I was like, who's this young kid? He does okay, and then find out he's a pilot, he's a network engineer. Terry throws a resume out there, 34 year. He's an economist with ExxonMobil. I was like, oh, there's some talent here we've got. We've got the resumes here at Trading Analysis. You guys are all very, very accomplished in your prior lives. Yeah. So, yeah, I'm just joking. Yeah. But, you guys are all very, very successful. And I appreciate you guys working with me. I'm the lucky one.
Yeah.
Surrounding myself
Without
with
going
people
into
smarter
a lot of
than
detail,
me.
yeah, that was my last assignment was as the senior economist for the chemicals plant, in charge of run plan for the refinery and petrochemical complex. And we used some pretty advanced software to optimize the feedstocks and the product deliveries to maximize profits. I mean, buy the cheapest feedstocks to maximize the highest grade refined products within the framework of the capacity of every single unit inside the refinery and chem plant. So very complex programs that we use. So, computers, this is my game. So, anyway, on a personal note, I'm married. I've got 3 kids.
You're our quant guy.
Yeah. Our oldest daughter practices family law in Lubbock, Texas, and my son's a chemical engineer. He's currently working as a nuclear safety engineer in Pantex in Amarillo. And our youngest daughter is a sophomore at Rice University, and she's pursuing a bioengineering degree towards a possible pre-med. So, it just kind of all runs in the family. We're all highly technical focused and pursue. Have a passion for what we do. So, in addition to trading, I'm also an avid bowler. I do have a 300 under my belt. I couldn't find my 300 ring. I was looking for it the other day. So, but I do a few other things like that, and I'm a new Corvette club member. So got me a new C8. So you guys have probably seen a few videos out there of that. No, Todd, I'm not going to drive 100 miles an hour and get the ticket unless you want to pay my court fees.
Well, when we have a company meeting in Texas, can I get behind the wheel and try it?
We'll find some places to do that.
All right. So I'm showing on the screen here your role at TA, and that's when the boss comes to town, I've got to be able to have a go at that Corvette. I'm just kidding.
All right. So in the infancy of trading crypto trading, let's say back in 2018, Alex and I started the first Forex and crypto trading service, mirroring what Todd had done with his stock swing trading service. And so that we got that off the ground, and Alex is running that now. In late 2020, I became the director of research at Trading Analysis, and I discovered Optima and relative rotation analysis, and I've been researching this new way of looking at the markets and have been providing interpretive analysis of those rotations of the sectors and stocks within those sectors to our clients, and also internally to Todd and Bennett for our own application. So while Todd was learning to be an RIA, getting all of his qualifications, I was digging into the background, and I said, Todd, you got to use this. You got to use the RRG. I said, this will help filter out and sort through the mass of stocks out there and help you build that portfolio. So Todd's also been digging into the RRG quite extensively, and he uses that as a framework, one of the frameworks for assessing what he wants to put in his portfolio for his new age wealth clients. So, all right. So you want to talk about my approach to the markets. So how do I differ from the other guys? So my trading style is geared towards intermediate time horizon. I don't call myself a day trader. I've been known to put on a few day trades, but that's not my forte. I'm looking to trade, in an intermediate time horizon with a combination of short-term swing trades and some longer-term stock trades, and I look out weeks to months in that type of holding period. Now I use a combination of technical analysis. The results of various technical screens help me identify stocks that are demonstrating strength in the face of broader market weakness, and then further analyze that smaller subset within a framework of Elliott and fib analysis, to help define my trade plans. So that's the basis. You need to know what stocks are outperforming. If your intent is to outperform the benchmarks, so when our benchmark is typically the S&P. So we need to know what sectors of the market is not only currently outperforming, but what is that general trend, right? So what we use the RRG, and I can do a screen share if you want, Todd, if somebody wants to give me the screen. Let's do this here.
You should have it. Yep. Terry.
Yeah. Okay, there we go.
Yeah. Here, let me just
show you what we're doing a little bit with Optima. You got me now?
Yep. Hang on one sec, and you are live. There you go.
All right. So Optima is a very elaborate charting platform, and it has many tools in it. And just one of those tools is relative rotation graphs, which I'm primarily focused on. But we have a variety of technical things that you can do inside Optima. I have this workbook set up with the S&P. Here, I'll start at the beginning. I have the S&P, I have the NASDAQ, I have the weekly performance of the 11 sectors built in here. And each week we go through and we analyze what happened last week, and we look forward to what's going to happen in the next week. This chart here, this is the RRG chart. And this is it's a grid coordinate system with along the x-axis is relative strength versus the benchmark, in our case the S&P, and along the y-axis is relative momentum versus the S&P. So this is not telling me necessarily the price action. This is telling me the price action relative to what the S&P is doing. Okay? And for each one of these sectors, each one of these line segments, in this case, this is a weekly RRG, so it's accumulating the data for the whole week. And in this one bar, the length of this line segment here shows me velocity of the move from this point with this relative strength and this momentum to our current point, okay, at the end of last week, to where we are right now. You can see this dramatic push we've had here in energy relative to the S&P. So we can compare not only individual stocks and sectors to the benchmark, but we can then look at them relative to each other. And then we can also look back in time. As I stretch this out here, I'm looking at 4 weeks of movement, okay? And within these, let me animate this a little bit. Let's go back in time, and we'll go all the way back to beginning of 2022. I'm going to maximize this window since this is what we're talking about right now. And so coming into the beginning of 2022, this quadrant here is known as the leading quadrant because the relative strength is greater than 100 and the relative momentum is greater than 100, all inside this quadrant. So that means that anything that's sitting inside here is outperforming the S&P dramatically on both metrics. Okay, at this point in time, early in the year, we had the real estate sector, the materials sector, and the tech sector, and the communication discretionary in the lead. Now, the headings here, I can tell from the direction of the last 4 weeks move at this point that we were seeing a declining momentum, right? Remember, this is momentum on the y-axis, so we were just seeing a declining momentum in consumer discretionary, okay? We had seen a big decline in energy, but then there's this hook here, right? So what I've been doing for the last couple of years, not only just understanding what we're doing here, but starting to interpret what I see in these hooks. Now let me just animate this for you. Let me show you. As we move throughout the year, you can see energy shot way up high, right? By the time we got into even early February, energy was way up here in terms of relative strength. Now we know the energy sector totally outperformed all the way up until about June. And around June, that's when we started seeing some changes. And let's see, I'm going to have to get, yeah, energy was the way top performer all the way up until March. And there's a pause. What happened? Something happened right here. There was a change in momentum at a fairly constant relative strength, right? So the relative strength on the x-axis, so just a drop there, holding that high relative strength, but that upward momentum shifted out of energy. We continued to see energy decline, but even though it declined through April, in the declining momentum, it was holding this high relative strength. You want to have your stocks, you want to be owning stocks that are demonstrating high relative strength. You want those in your portfolio. At the same time, we were seeing utilities advance, staples advance, and other things, but the energy was way out here by itself. So it's kind of like you gotta okay, energy's doing its thing. Let's go back over here and take a look at how do we decide what we want to trade, here. Technology had already moved into the lagging quadrant, consumer discretionary, communications, and then we saw finance disappearing from the weakening quadrant down here. What we call this red one is the lagging quadrant, right? Because anything in the lagging quadrant, it's under 100 in terms of relative strength, and it's under 100 in terms of relative momentum, right? This horizontal here and that vertical there. All right, so we continue going. We see energy continue to hang out all the way through June. Okay, right here in mid-June, we see this little hook forming. Okay, then we see this rapid reversal. You can follow that. So since June, we saw energy trade come way off. Energy almost entered the lagging quadrant. At this point, prior to this point, Todd had, I know Todd, you can jump in here. I know you had overweighted your portfolio in energy based upon this. Okay, coming into the first of the year, we had put you in an overweight position relative to what the energy typically is in the benchmark S&P.
You know, actually, I launched the RAA, believe it or not, October 7th of 21. We launched with like a 2.5x weighting in October to the S&P. So it had already made the move. What's that? Give me dates there on that XLE.
Well, this right here is at the
Okay, so
first
that's
of the
January.
year. This is right
okay.
around the first of 2022 when we started to see XLE. It was already in the leading quadrant earlier than that. Right?
Yeah, so keep going, keep going.
It had played down.
But I'm saying
a little bit, but
hold on. Energy was outperforming back in September, October of 21.
Yeah,
I mean,
exactly.
And the energy trade got hip in the first quarter of 22, and I'm saying, guys, you missed the good beginning of the trade.
Yeah.
Yeah.
Yeah, but energy's hit took it down into the weakening quadrant, and then it rapidly hooked back up, and then it just accelerated. Now, later in the summer, though, I know after we saw this momentum coming off here in April, I think you downsized some of your positions in energy for a period, as we saw then energy continue to rotate back south. So here energy trade is coming off. Okay, but then we started to see this hook. This hook here tells me there was a change. Okay, the whole thing is called sector rotation, and this is how we visualize sector rotation. So we saw the change right here, and I think somewhere around this point, you actually added back in to your energy position. At least that's what I think I heard you say.
Yep.
So now we have energy rotating right back up. Energy's way back in the lead.
And we could talk. This is a long conversation. This webinar is going longer than we thought, but that energy is now moving back up, not because of fear of inflation, but perhaps that central banks are going to pivot and not drive us right off the recession cliff. So a little bit of commodity reinflation would be good because the air already came out of the commodity bubble. So it's almost like it's actually a risk-on thing. It's a good thing that commodities are coming back, and I don't think a lot of people understand that, but it's clearly right there in the rotation.
Yeah. Energy should be in the toilet if we go into a big recession.
Right. Right.
Well, energy's not in the toilet right here, So anyway, this is one way that Todd and I utilize this, and we try to interpret this each week for our clients so that they can utilize it in their own aspects. Now, I drill in. So this is one level, right? So Bennett will start out with the S&P and the NASDAQ and give us the idea where the indexes are going. Okay, and I'm going to come in and I'm going to show you. I'm going to take that S&P and we're going to break it up into these 11 sectors. That's the first level, right? So now that you can see which sectors are in an outperforming condition, if you want to decide how you want to put, you have your own portfolio that you're managing, and you have an indication of which stocks you want to put in it. At this point, I would say it depends on your time horizon. That's another thing, right? I believe that I'm in the camp that there's always a bull market somewhere, and that perspective, again, depends on your time horizon. And certainly I do agree that we're in the throes of that bear market.
Did you just do a Jim Cramer quote there, Terry?
Yeah, well, don't say that because then now we got to give him a royalty. So but 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 there will be stocks that start moving ahead of the indexes starting that next bull market. Now finding those gems is my mission. And perhaps you could say that I'm looking down the road to the horizon while I'm dodging the potholes along the way. Okay? I'm not day trading with this. I'm looking to say, where should we be investing? Because during these next several weeks and or months, these are the sectors that are going to be outperforming the S&P. Now, Bennett or Todd's going to be the one to tell you where the S&P is going, but I'm going to tell you that stocks that are outperforming over here are not going down as fast as the S&P. And that's another thing we do. So then we drill inside these. Energy, I take it another step further. I'm going to go into consumer discretionary. Let's jump into consumer discretionary and get off the energy trade. Consumer discretionary has been in a declining momentum. You can see that for the last 3 weeks. But it's basically doing it at a constant relative strength, and that relative strength is higher than the benchmark S&P. So consumer discretionary stocks are actually doing quite well. Here's a plot of the XLY, right? So the whole sector itself includes, and I take like the top 30 by market cap. I don't know exactly how many stocks are in the XLY, but there's a lot. But then we can dissect that and we can use additional technical analysis tools. I've got a fib retracement tool on here. I've got trend lines. I've got support channels. I've got a moving average convergence divergence indicator, and I got a relative strength indicator. These simple additional technical tools, in addition to, you can see where I've applied some Elliott wave on here, usually following Bennett's lead on what he sees in that. And so I can kind of combine all that together. Now, where I wanted to go with this is I want to show you, this is the RRG map of just the consumer discretionary sector. Okay, so within this map, it's the same thing: momentum on the y-axis, relative strength on the x-axis, and the S&P is the benchmark here in the middle. So I can compare all of these individual stocks, right? So we know the XLY has got a higher relative strength. If you can kind of think of it, I know that all of these are market cap weighted, so they're not equally weighted. Okay, each individual stock has a different total market cap, and this particular analysis here is by market cap. Okay, not by individual stock. But you could probably see that there's a majority of the stocks within the XLY that are sitting to the right of this vertical axis. Okay, that kind of, it goes back and tells you here's where the XLY is overall, right? So if you think of that little data point right there as the sum total effect of all 30 or so of these stocks that we're looking at right here. Okay, there are some that are lagging, and we can identify which ones of those that are lagging, and there are some that are leading. Okay, and some that are leading even stronger than others, right? Starbucks, for example. Starbucks is doing gangbusters. So is O'Reilly, TJ Maxx. Now, will these do that forever? No, because again, there's this rotation that occurs. So we track this rotation. So as I'm estimating this, we just go back to 1st of September. You can see Chipotle Mexican Grill running way out front there. Okay, well, it eventually stalls a little bit and loses some momentum. Okay, but you can see the thrust. We can infer week over week, and you can do this on daily and you can do it on monthly time frames, but you have a totally different perspective when you're doing that. I find that this weekly kind of fits my intermediate trading time horizon the best, and really matches up to reading the daily charts on the Elliott wave analysis, right? So it fits my time horizon that this projects to me the stocks that are going to continue to hold their strength. Now, let's take a look here. We got some yellow coming in here. Tesla, Ford, GM, and Amazon. If you can see their vectors right here, Tesla has been a very strong stock. Okay, but then it all of a sudden rapidly started losing momentum. We've seen that. We've seen the Tesla trade come off 100% retracement of its move upwards. So it's lost all of its momentum. Currently, its momentum is neutral with respect to the S&P. Okay, Ford, Amazon, GM are falling off, but we've still got all these others that are holding strong. Now, these little hooks back to the north in the weakening quadrant, that's very interesting because these stocks actually are re-accelerating back into the lead. You can see where they decayed for a little while, but they never really fell off the map. They never penetrated over into the lagging quadrant. These stocks are reaching back for new highs, new relative strength. They're holding their own against the S&P. So just because their momentum faded, we watch for these reversals. This right here is sector rotation. The definition. This stock is rotating back into favor, and those are the ones that you may want to start to investigate because they're the ones that are demonstrating strength in the face of the broader market weakness. Let's just look at AutoZone. I could have pulled up O'Reilly. I think I like O'Reilly a little better, but that's only because I wished AutoZone would go ahead and do a split. So, but it's all relative. Just look here. I'm gonna pull this chart out. It's not straight up, but I got a long-term uptrend channel going on in AutoZone. Yeah, we had a big correction. We had that. Where was that correction at? Let me get that out of the way. That was from April to May. We had a big correction in AutoZone, but basically AutoZone's been trading up. Well, where's the S&P been going since May? Well, yeah, we know it went up a little bit in August and then it collapsed again. But you don't see that. You don't see that magnitude of loss here. This is the demonstration of that strength in the face of broader market weakness we look for. And we start to collect those because I'm personally of the belief that when the market gets its legs underneath itself, okay, and is ready to move higher, we want to know those stocks that are holding that strength. They're going to be the first ones out of the gate, okay, and they're probably going to be the ones that move the highest when the bull market returns. So you got to be ready for that when time comes.
That's right.
All right,
That's
I think
right.
I probably overstayed my welcome there.
No, we have a lot. Obviously, there's a lot of content. Everyone is working towards the same goal, obviously, to get the stock index direction the right way, then filter down and figure out, we're going to bring Alex in here, as I've said a couple times, what macro markets are impacting the direction of the stock market. So fixed income, commodities, currencies, and equities, those are your four major asset classes, and maybe crypto is an asset class. And then, as Terry just mentioned, we look at relative strength and weakness of the sectors, and then he just showed you the tip of the iceberg. We get down into industry groups, and we find the best stocks to be long and uptrending markets, and weak stocks to be short and downtrending markets. So we're all working towards a common goal. We have a slightly different approach to it, but we're all working together. So good work there, sir. Thank you very much. Let's turn it over to another longtime friend, Alex K. What's up, man? How are you?
Hey man, just enjoying the overall outlook as we present. So sometimes you overlook and kind of in a daily business forget how much work everybody puts in.
Yeah.
To kind of
And Alex,
through all of this mess.
And Alex is in Serbia. He's tired. What time is it there? You're 6 hours ahead. It's not that bad. It's like 9:30, right?
Oh, it's 9:30. I'm gonna go out. That's it. So everything.
Are you going out? Oh, good man.
Yeah. So cool.
What are you gonna do?
I'm gonna usually when I do some type of a good day, I reward myself with a glass of a nice cognac.
Oh, very
So
nice.
yeah, so I like to savor it, enjoy it. So usually when I fulfill every task I give myself during the day, I go and reward myself. So this is
Very
going to be
nice.
the same tonight.
All right. Well, let's finish strong here, guys. Let's hit it. I know we got to get. We got to get Alex's audio. Got to speak up a little bit. We got to get you a new microphone, Alex. kind of mumbling. And this is Alex is going to bring the heat on the macro front. So I've known Alex, man. When did we first start interacting? Was this back in 2007 or
Yeah,
eight?
my first email to you was 2007.
Okay. Again, try to speak up, man, because again, your microphone's pretty low.
Oh, okay.
Yep.
Okay, so first email was in 2007, actually.
Right. Right on. Right on. Yeah, Alex. We met when I was working at Forex.com during the global financial crisis, running research newsletter, trading for the hedge fund. Alex has got was part of a pretty active trading group in Belgrade, Serbia. And they reached out, and that was my last corporate job that I actually had. And Alex emailed and said, "Hey, would you come out and talk to us? They have a real active forex and trading group, and they specialize in LIQUIDITY. It was really fun, so I convinced my boss to let me fly out there, and we had a great time. Played golf with Alex and saw Belgrade, which was great, and actually wound up turning into another trip, and then." So this has just been a lifelong friendship, and I'm lucky to have him working for me. He's got really good institutional experience. Alex, I'm going to turn it over to you, and I'm going
Sure.
to take your bio and just put it right up there and tell us a little bit about where you're coming from, your trading experience.
Sure. Okay. So hi guys. As you can see, my name is Alex or Alexander. I've been in finance almost all my life. Actively, I was trying to read, as I remember, the Financial Times when I was 15. It was just a bunch of news and numbers. Later on, I went to France. I finished my BBA in finance, studying in Paris. And afterwards, I came back to Serbia, which was in a pretty dire political and I would say geopolitical mess at that time. So there were actually no banking system. I was working for once a brokerage house. Stock market was just beginning here. But post 2000 changes, I've started to work for a large international bank, first in a corporate sector, and then I was finally moved also to treasury when I was holding the FX desk on a domestic at foreign currencies. From there, I moved into private hedging strategies for a couple of companies, big companies here in Serbia. So my beginnings was as well as Todd's. He was in stocks before, but he actively was in FX, and we started back and forth. And then when I saw his work, actually my journey into the Elliott Wave world started, and I was really very happy to find the methodology which I started to follow and study. And I have been a student of that since, so it's almost 12, 13, 14 years. My approach is a little bit kind of on a higher time frames. I'm a trend following guy. I like to pair up the global macro scene with particular assets classes. What I'm looking also is what's going on with the central banks, interest rates, geopolitics. So I use that as a filter when I apply to a particular market. And in this case, this was cryptos. I started to work for Todd at 2017 as a kind of a main lead in a crypto desk, and we have had a couple of successful things in the last couple of years, and we were, I would say, I will not be modest here. We were in front of every major up and down and highs and lows on a crypto space. Also, I was one of the rare guys to kind of noticed the connection between the Bitcoin a couple of years back with the stock market. We were pretty much in a crypto craze at that time, as we are cooling now. That was a fun times because I will show you a couple of charts, couple of things that this cross assets and macro via crypto analysis has yield for in a sense of pretty in front prediction what the Bitcoin price will do. We have a very nice crypto desk at Trading Analysis. We have a very nice over the world membership. We have extensive service. So we cover that from all sides. We cover more than 50 cryptos for our clients. In basic, I'm a trend follower guy. I like to look higher time frames because I think they're, in my point of view, more reliable and a more kind of a lasting than a smaller ones. Of course, I do go on smaller time frames, and that's perhaps because I was trading almost for 10 years on the FX desk of this international bank on almost 1 minute charts, because there was a huge lots involved, relatively big sizes. So I have spent almost I don't know 8 active years, between 8 and 10, trading every day on 1 minute or 5 minute charts. And then I get really tired of that because it was so intensive, and I start looking how I can avoid it in my after bank life, and I just lifted the time frames and find out how I can filter through the price action, looking all of these macro things. So that has been my journey since now. Of course. I'm going to stay with this approach because I think it's a very giving me or us a very good results. And in free time, I usually do a couple of things. I'm also golf fan. I do try to play golf every week. I do kite. I do Muay Thai. Also, I do kind of a last, and the guys was making fun of me. I started with kind of a practicing shooting with firearms. Here in Serbia, laws are different than the United States, so everybody was laughing at me. Come on, Alex, you're 50 years old and you're starting.
We're
now.
laughing with you,
Okay.
Alex. We're laughing with you, man. You're in the. We're laughing because I know you served in the army, and I'm saying they didn't have you shoot, but then you clarified.
Yeah. We didn't use pistols there. We used AK because it was the old Yugoslav army back then.
Yeah.
But this new experience, I have a shooting range just 2 streets away from my home, so I'm regular now. So enjoying that. Hoping when I visit you in Texas, I will have a chance with Ben and Terry and you to go and we shoot some things.
So what you're
together.
saying is when you ask for a raise, you need to consider the fact that you know Muay Thai and you know how to shoot AK-47s. Got it.
Yeah.
Check. Understood.
And, yeah. So.
All right.
Yeah,
Tell us where you want to go. Do you want to hit some charts?
So,
Tell us what's going on here.
Yeah. So let's go first look what I'm looking on the macro scene, and then we can switch and throw that on a Bitcoin chart. So I'm going to try to be a little bit faster. So my usual screens and the day starts looking all of these assets classes. So I'm very involved in studying what the central banks are doing, also overall economy of the developed countries, how the mechanisms are functioning. That has been my interest for the last couple of, I would say, 5 to 8 years. I'm usually looking every asset class and what is going on there. So I'm starting the day, of course, looking when we have a central bank's announcements. What is this going now in this inflationary thing with the central banks? I'm tracking very closely 10-year yields. And of course, with the Elliott wave counts and trying to figure out where we're going to have the end of this first cycle on the upside, which I think it's approaching. We are trading in the range. We have been calling that range for a couple of months now. So I do think yields has a potentially a little bit more to go. We're going to see, I think, a pullback and then a final push up. So there is a 5-way sequence there. and from there, this pairs up with our overall view that markets are gonna still continue higher when this higher correction comes. Some of the levels I'm looking are pretty low. I'm not gonna speculate on that now. I will do that regularly because we are every Wednesday on the live stream. But I think we're gonna see a sizable 2023, maybe in Q2, sizable move to the downside in rates. Also, I have a couple of charts. Also, my opinion on the S&P, also dollar index is one of my focus. I think we are coming into the zone where we're going to see a significant dollar index reversal from 2000 and lows, 8 lows. Dollar has been moving on the upside from various reasons. I'm not going to go back into that. I will need half an hour. But currently, one of the main components is the interest rate differential because the Fed was first in hiking. The rest of the central banks, including their geopolitical and personal countries' economies, are trying to catch up. So we are still on that front, moving on the upside. European front, 10-year bond. I'm closely looking what the European future markets on rates are doing, and also 10-year bond in Germany. So this is also very telling, kind of aligns with the 10-year yields, but in smaller increments in the yields. So this is a 5-wave sequence, which I'm also looking in the European front. So this is also one of the things which I'm tracking very carefully. I'm looking Thomson Reuters index, tracking this index for commodities, what the commodities are doing. Oil is also one of the interesting charts which I'm tracking very closely. So all of these markets are very interesting because they affect the other markets, although we have seen some correlation, which was traditionally was holding back when we were trading like commodities down, dollar up, and vice versa. This cocktail of COVID and geopolitics, and also the global deflationary, inflationary cycles are now slowly destroying these correlations, and I think it's going to destroy much more in the future because we are in a kind of a turn into these geopolitical things, and there is a lot of things I think to come in a financial way. But anyhow, for me, it's very interesting to pair that with a particular filter out with a particular asset class. So let me just show you what we did in a Bitcoin, and very quickly pass what we have been looking. This is a 2017. I have started to move into the trading analysis where this consolidation was going on. As the Terry and I was joking, looking the grass grow. We were bearish on a Bitcoin down to 5,000 to 3,000 K already from here. Of course, this is the lows which we called. We had a buy limit, I think, which was missed by 20-30 bucks here on these lows. Market was very negative, and also I want to mention one of the things I'm paying a very big attention, which goes aligned into deep psychological thing, into the Elliott wave theory. It's sentiment. So its sentiment is something which you doesn't have. I mean, you have a couple of indicators which follow sentiments on a basis of a trading exposure. Like you have a COT data and a couple of other things, but I think sentiment is a really important one. And if you train yourself to kind of feel the sentiment where it's the most negative, most positive, this helped me also very, very much with kind of calling these tops and bottoms in a Bitcoin for the last couple of years. So we had a call that this will be a terminal low, that actually Bitcoin around 3,000 will continue further on the upside. And of course, media was already destroying Bitcoin. They said Bitcoin is going to go below 1,000 by next year. Of course, that didn't happen. This is the beginning of the Bitcoin rise, which we traded on the upside. And then, of course, this is a couple of charts when we looked for targets around between 69 and 74K much before And this is really the power of Elliott wave and Fibs. We were looking for a pullback here in a wave 2, which was a COVID low actually. So after that COVID low, we were looking for 69 to 75, 80K for the wave 3, much before that anybody had an idea actually that Bitcoin will move to such an extent. Of course, the fiscal policy, monetary policy was going in line with that. We had ample liquidity and narrative to propel that on the upside. That was also one of the things we looked. And as we came to these levels, I think I was probably the only guy. I don't want to sound kind of backing myself, tapping myself on the shoulder, but I didn't see at that time either from any big macro guys following cryptos or any technicians that actually somebody called this wave 3 top on the upside, as you can see here. So I missed that for a couple of thousands in a Bitcoin because I've seen the sentiment going wild. So Bitcoin here, from many media, YouTubers covering cryptos was calling 100, 200K, 500K, and any sorts of numbers. And I look a couple of things that we look in line with Elliott wave methodology, some of the Fib ratios, and I said, this is going to be probably a big reversal to the downside, calling a kind of a 20K in this wave 4. And actually we went there. We had a couple of patterns which can develop in this fourth wave, but this was a very early call. This was March 14 of 2021. What everybody was thinking that cryptos are going to go to the moon and actually behaved like that. So the sentiment was a very important thing in me determining with this couple of technical things that most likely this is going to be high. And also some, I like to use this couple of technical things on a higher time frames. This was also the RSI on a weekly level. This was actually on a monthly level, which was showing to me that we are reaching some of the highs in a line with this. So I do kind of a mix of that on a higher time frames, which really gives a big kind of a probability of reversals. So calling these lows, also calling these highs here. We are now in the phase that we also called the 69.74 craze. In the 2021 November, market was poised to go to 100K. Many retail clients fell for it, went extensively long in the Bitcoin just to be crushed in a 2-day move down to 40K, which decimated the retail space. Of course, all of our clients was very safe and sound through this. Nobody lost its account and actually didn't suffer any major loss because we were in front of all of these moves. So this is actually a call for a 20K move from 69 to 72 resistance levels. We have a very two distinctive Fib ratios, which helps us, and we actually call the reversal probable either in triangle or in flat downside. We are now currently in this zone. So mixing all of these things, actually, this is not just the, as I said, the Elliott, it's the macro things. It's a couple of things that I use from the usual technical things. So I kind of do a mixture of that just to filter out my levels using the Elliott wave methodology. And as you can see so far, we have announced this all in advance. It has been pretty successful, as you can see from the charts and my Twitter feed. All of this is live in Twitter. So we are looking now in these zones. I'm going to go to a live chart just to show you what we are seeing now. So we are still looking on a bullish side because of the specific things in the Elliott wave methodology. There is a couple of rules. So I'm still going to stay looking for a reversal very soon. I think this is going to last for a couple of more weeks, most likely some type of a triangulation flat. I want to see a small movement lower, and then we're going to start loading up on the long side. So this is the kind of a longer term picture that we look. Also, we do look Ether and Ether Bitcoin crosses. which I can show you just quickly because it looks pretty nice from that perspective. Just simply for the reason that the chart for that is very clear. Let me just go into that and look for Ethereum Bitcoin chart, which still looks very bullish to me. So this we also were on this chart from the regions here where we actually spotted this leading expanding diagonal, which is also has a specific rules within it. So after a pullback, I've called the move up for the Ethereum Bitcoin chart, and I think this is going to continue when this correction is off. So I think Ethereum, as well as it's holding now, because the Bitcoin lost its narrative. If you remember, guys calling this crypto kind of a new inflation hedge, kind of a new pristine collateral, new gold, all of these stories fell out in the water. And that has been my thesis for 2 years now. Nobody listened because I was probably the only one bashing the Bitcoin narrative. But actually we see that now that Bitcoin is behaving like a kind of a high beta volatility trades and stocks in the Nasdaq. So it has a tight correlation. I think from a currency perspective, we still don't use Bitcoin to that extent that it had actually lived its beginning of an embryo life that it was actually designed to. So all of these other narratives failed for now, and I've been pounding my drums from 2021 or even before that this narrative is not sustainable. And currently we see that. So Ethereum as a network, especially with the current merge, I think it's going to be more use case, at least for now, because of the specifics and a different use case scenario than a Bitcoin. This can change, but I think in this cycle, it will not. Also, I follow the metals chart. We do that. Everybody of us also follow the metals chart. Metals are also one of the components we are looking from the Elliott wave perspective as well. So this is the chart of gold. We have been troubling for in a large sideways consolidation for already a couple of years, 2 years already and more. So we have been very in forefront of what has been going in gold, just because we utilize this beautiful methodology, which is warning us ahead of time that some consolidation will come. And of course, later with our capacity that we all have in the trading analysis, we do dissect this and kind of start to pinpoint the most probable entries, the most probable lows, and the confirmations where the signature, reversal signatures might occur, and then we can jump in on an uptrend when we have we see signs for it. So I've been enjoying this Elliott wave methodology for a long time. I'm a big fan of it. I do really think that it is something which has entered my life from numerous reasons. I have looked also some other phenomenon in life. I think guys remembers we have a famous Serbian tennis player, which is Novak Djokovic. So I explained the guys, I put his career in the Elliott wave mode. So that was very interesting also to see. So this kind of patterns depends on I will say volatility of a certain asset class or volatility of life. Can actually tell you, because as humans, I think in my opinion, we all seek orientation. Every time we wake up, we look what the time is, what we're going to do next day. So we need these orientational posts in life, because otherwise we will be lost. So we have a time measurement, we have a star measurement, we have a compass to measure the sides, we have a month to measure the passage of time. So measurements plays a big role in our life and orientation. So I think every human being on this earth seeks either in a relations to each other or in some other things. Also, we look to our political leaders as an orientation when the country and the economy goes. So I think it plays a big part in everybody's life. So what has Elliott and of course through Todd has given me is that very needed orientation, a kind of a picture what the market can actually do. Despite of forecasting tool, I have been also very much keen to apply what was Todd was saying for years now, that Elliott is primarily a risk tool, a risk management tool. So I do fully agree with him. I have been experimenting with that, and Elliott is a perfect forecasting tool. Is more or less like just one layer. So orientation is good, confirmation is good, and then on top of that, we can really do a very specific risk reward things. I know Terry is bashing me because I'm on a even larger than him time frames, but I like to have this orientation and kind of place these bigger trends. I think they usually yield a less psychological energy and more returns on a longer term basis. So if I missed anything, guys, can you just remind me, or back to you, Todd?
All right. Thanks, Alex. Well said. Well said. And that's a really good point that I think we try to put in front of our customers is Elliott, in really all analysis. It doesn't matter even if it's technical or fundamental. I would say it's all subjective. I'd say it's all lousy at forecasting. That's why I think it's all subjective. I mean, rising interest rates. Let's ask 100 economists: is that good for the economy or is that bad for the economy? I bet you'll probably get 35 different answers on there. So, it's about using the tools that you feel comfortable with, and Alex just spoke very eloquently about Elliott Wave. It's certainly not for everyone because people, don't want to sort of show that their level of EQ, of emotional intelligence, which is not how smart you are, IQ. It's how emotionally intelligent you are, which is you can't predict the future. And you have to be okay with that. You can't stress and say, oh, I have to know what the market's going to do tomorrow or next week or next month to make money. No, you have to find and define your style of analysis to assess where we are in the market, whether technical, fundamental, intermarket, any form of analysis, and do your best to go through your checklist. Make sure you check all the boxes because ultimately your money is going to be on the line, and you have to do your best to assess the situation now, to put yourself in the best position now, have confidence in that methodology, because when money is inevitably changing hands tomorrow, next week, next quarter, you have to have confidence that you did everything you can at the time where you planned that trip. And the rest you have to let the future take care of it for you, and you adjust every single day. I'm managing longer term portfolios, as the guys mentioned, in the wealth management side. I've been more active in the markets watching on 5-minute time frames, 10-minute time frames than I've been in years, just because of the volatility. But that's what it takes. That's my process. When volatility gets crazy and we have 28, 30, 32, 34 VIX, which is still relatively cheap, your time frames are going to expand, and you're going to look at different things, and then volatility will ultimately head back down because it is mean reverting. It's not a trending instrument, and you got to adjust. So every guy, go ahead.
Yeah, just to add, I mean, as you said, it is subjective, but as I observe human psychology. As I said, we need some type of a form to have an orientation. So either you take any type of technical analysis. Can you imagine being in front of this market with just your emotional tool, which is anyhow as a human very volatile?
Yeah,
I mean,
it's a good point you bring up.
How you will relate to all of this?
Yeah. Just a simple. Here's a simple, just a simple story. I mean, I was 22. I think I was professional. I was a prop trader. Sorry, my earpiece is falling out. Good thing it doesn't do this on air. I was 22. I was prop trading in San Diego, and I learned how to scout, try to take 5, 10, 15, 20 cents out of New York Stock Exchange stocks, holding the trade for like 20, 30 seconds, listening to the S&P futures in the background. And that's how I learned to trade when I was young, very micro time frame. And I remember I was like, man, I would just love to be able to hold a trade for 3 hours. And I remember I bought the QQ, it was the quad Qs at the time. It was the quad Qs, and then they went to the triple Q. But to hold a trade for 2 or 3 hours when I was 21 was torture for me. It was like I couldn't do it because I felt so lost. I couldn't manage my emotions. And then as I realized I didn't want to day trade for the rest of my life because it feels like you get out of the boxing ring at the end of every busy day. I feel like you went 12 rounds with a heavyweight. I had to find a methodology that would allow me to manage my own emotions, provide a framework, provide some guidelines, a framework, tendencies, rules that the market should kind of follow as it's trading through the day. And if you can sort of lay out those upper boundary, lower boundary, say it's okay if the market fluctuates within that period. That's expected. That's within the methodology. It helps you contain that emotion that you ultimately will feel. Where, as Alex just said, if you're just trading, put something on, I really have a reason why I'm doing it. It goes against you. That's very threatening information, and you'll make an emotional, usually poor decision. So it's a framework, and you got to find the framework that works for you. And this certainly isn't for everyone, but we have clients all around the world. The business is coming up on 10 years old. And obviously, we have a strong analysis team that helps them manage their own emotions, and we all have it as humans, in whatever time frame they're trading. So that's a great thing. You can do this on a 5-minute chart, 50-minute chart. You can go up to a daily, weekly, monthly, quarterly chart if you want. But yep, go ahead, Alex.
Yeah, no, I just funny thing. Sometimes when I think about it, it's like. Any guy who kind of reached some analyst point to observe the market, you can just behave as a doctor because you're determining the state of a patient. So we always look in which state of the market is and what's going on using different tools. So I will also look at from that perspective, which is a funny one. You just kind of try to determine where you want to be exposed. And what is your risk? I mean, that's the bottom line.
Yeah, that's it. It's a trading methodology, and most of it is. It's if you look at indicators, you look at overbought, oversold indicators, you look at interest rates, you look at economic data. I mean, how do you manage risk? If your model is based on, if your methodology is based on an RSI or stochastic or any momentum back and forth indicator, there's a billion of them out there. If it gets overbought, what does that mean? Get out of your trade, stay in your trade, do you add to the trade? Like, it doesn't help. A lot of times some of the best uptrends go overbought very quickly in the oscillators and stay overbought for a long period of time. Yeah. Just like this, you look at any indicator right now on the downside of the market, it's been oversold for weeks and months, I bet. And hopefully you're not covering shorts, and hopefully you're really not trying to buy unless you have a time frame, unless you have framework in which you're like, okay, here's my risk, here's my purposes for being committed to the market, here's how long I want to be in the market. As long as you provide yourself that framework, you can avoid some pretty costly mistakes. Go ahead, Alex.
Yeah, that's it. I mean, you pretty summed it up from your big experience. So I'm really, I mean, that's kind of this type of event of meeting you, contacting you to come to Serbia, which was a pretty bold move by you at that time.
Why?
Serbia was not very. We just went from the war.
Whoa! You didn't tell me that at the time. I never heard that.
I didn't. No.
Hey, I was like 25 or 26. I don't care what danger there was. There were some pretty girls out there. I didn't care what danger I was in, man. I hope my wife didn't hear that.
It kind of changed the course of my life, in a sense, of my professional career, because it's kind of this event, you cherish because it changed your life.
Oh, I appreciate that. Oh, we're getting all mushy. All right, Alex, enough of this crap.
Okay.
Thanks, bro. I appreciate it. I love you, man. Thanks for everything. All right, so, well, guys, you just heard from the TA team. I thought you guys have done an absolutely amazing job. You can see how each guy in the team contributes. It's hard to see it all come together unless you come in and see it at work. We can talk about it. We can say, here's what we've done in the past, which I know I don't like hearing that either. We got to show that we actually can make some market turning points and calls on market turning points. But you got to see it in action, and that's the cool thing about it. You sit down, and every day is different. You got to see. Some days it's the macro, intermarket analysis. Some days, whatever is moving. Maybe, certain LIQUIDITY pattern is unfolding, and we want to switch over to the options market, or it's better to be trading stock. We try to approach it as, we can cover a lot of bases within trading analysis. It's not as simple you sit down and here's your indicator and you buy when it goes here, sell when it goes here. I mean, that's super easy. You can learn in 15 minutes, but that's clearly not what we do. So we've gone a long time. I'm gonna skip over on my part. We'll probably save it for another time. I'll just flip through here real quick if anybody's really interested watching the replay here. Founded the company. We're coming up on our 10-year anniversary. We're gonna have some pretty fun things happening, so be sure to watch out there. I did step away over the last 2 years to fulfill my second professional lifelong dream. I guess that was my third. One was to own a trading membership business. I first started day trading when I was 18 on an AOL dial-up modem freshman year in college during the summer. And I didn't know it at the time until we got the phone bill, but it was a long-distance phone call from my town in upstate New York to Albany, and my mom got the phone bill and almost beat my butt because it was like a $500 phone bill. So carried through, started prop trading right out of college in San Diego. I worked on Wall Street for a hedge fund, wrote the research report that Alex mentioned, got to rub elbows with some big investment banks, traded on some of the biggest investment bank platforms in the world, and learned a lot and carried it through to the membership business that we launched. And I left in 2010, worked with my old boss for a while, and then launched trading analysis in 2012. Moved up here, upstate New York, 3 kids, about 4 years ago. Always wanted to launch the wealth management business. So first dream was to own a membership business rooted in trading. I guess the second dream was to have a TV presence, which I'm working on 10 years. And the third dream was to launch a wealth management business, which happened last year. So all good. Fun times. And then what else is real important? I'll show you one chart and I'll get you out of here. The team did a good job. Where is that? So that's that. I don't know if I showed my about me. That's pretty my approach to the markets. Yeah, I think there's one thing I do wanna leave you with here. One of the things, I guess I started trading when I was 18, and I was following, this crazy chat room. This guy is like, his name was Tokyo Joe. It was crazy, but it was one of the original online day trading rooms. I loved it. Loved the excitement, and I started prop trading, as I mentioned, short-term trading when I was 21, 22, right out of college. And as I've kind of progressed through the trading markets, my time frame holdings gotten longer and longer and longer and longer. Obviously that lends itself to the wealth management side. So, I think the one thing I can tell you is there's 2 ways that I know of to guaranteed make money. And I never, the guys say I never guaranteed that you make money. But my opinion, the best times to make money in the market are being long, swing trading, position trading, and low volatility bull markets. That's when you need to be long and passively trading. The The other time is when markets are falling and volatility is up. It's important to have an arsenal of short-term trading tools to move in and out of the markets. And this is the kind of environment we're in right now. You know, I have longer-term portfolios in the wealth management. We do have hedges on. I do have some option hedges on as well. I was going to show you guys that, but we're way out of time. But this is one of those times where I kind of dust off the skills that I learned trading through the 2000 tech bubble crash, the 2007, 8, and 9 global financial crisis crash with the end carry unwind where I met Alex. You know, this is times where you got to be very active in the markets, and this is when you need to learn what your style of short-term aggressive trading is, because when, sorry, but pardon my language, when shit gets hairier, that shit hits the fan like it is now, you have to be dialed in, locked in, and committed to your particular methodology, because when your money's on the line and volatility is going crazy, you can't be backing away and second-guessing your methodology. It's got to be locked in. And you got to recognize when there's opportunities in volatile markets like there is now, but when vol calms down, which, as I said, it inevitably will because it's mean reverting, you got to realize, okay, time to shift. And maybe it's time to start re-engaging on the upside. And that's another thing that I think a lot of people have a hard time is compartmentalizing your longer-term portfolios versus your shorter-term trading accounts. And there's quite a few ways that those two can overlap. And hopefully you do it the right way, because if you're longer-term like Bennett at 37, you know, these prices, NVIDIA down at 120 or 130, whatever, I mean, that's a gift for a tech guy like Bennett at 37. But, you know, we might have another 15% on the downside in NVIDIA or the semis, which have been very much leading the market, and there could be really good short-term option opportunities. So it's compartmentalizing, it's separating your accounts and understanding what you're here to do. And that's how I built the business trading analysis, which is good risk control, defining what your money is supposed to be doing for you in the market. Is it longer term money, shorter term money, what your risk is, how much you're comfortable risking, do you want to trade in the stock market or the options market? And we can teach that as well as having the proper tools to use based on technicals. And we didn't even talk about fundamentals. I do a lot of fundamental scans for each stock that goes in the longer term portfolio. So guys, we have a lot of stuff going on here at Trading Analysis, I can tell you that. So I guess, you know, the only thing I would say is I'm just going to put one simple chart in front of you guys, and then I will wrap it up here. Where's my screen share? Boy, did I even set up a screen share for myself? Let's see, I did. Here we go. You ready? Guys, you ready for this one? KISS, boys. Keep it simple. You ready for this one? All right, let me just make sure your mics are on. Okay, you guys are all on there. So here's the NASDAQ. This is the monthly. This is a log chart. So you can see that the distance, 1,000 to 1,050 in the NASDAQ, that's 50%. And that same pixel distance on your screen right up there is about 50%. You know, it's key to look at those longer term logarithmic scales. The fib levels and the trend lines will come in at different places. But me just being a simple man, I love making money in uptrending markets, which I still do believe we're in one. Do a trend line, capture the COVID lows, stretch it on up. What do you think the low was today? On top of that, take the 2007 and 8 GFC, which was 55% decline, which is actually a fib number, and you multiply that by, here's a little math for you. Is 55 times 0.618 is 33.99, which is 34%, which is another Fibonacci ratio. And then if you look at the NASDAQ, right here, we are right at this to the low, minus 39. And then if we put it right about here, it should be about 34%. So this is a monthly chart. We're halfway through the month. We can get down to a week. We'll get a couple weeks into this month. We'll get down to a smaller time frame. Let me stretch it out here. Sometimes you got to play with log charts with kitty gloves. But That's that trend line that goes all the way back to the lows. This is a 34% decline. That's kind of being echoed by this fib right here. And I don't know. We've spent a lot of time trying to figure out what this decline is from the 2021 highs. Is it complex? Is it a 5-wave move down? Is it the end of the world? We don't know yet. We don't know. But we've spent a lot of time and banged our heads against that's not a good way to say it, but we've spent a lot of brain power and consumed a lot of calories in our brains doing everything we can to figure out if this is the beginning of something much more catastrophic, or is this just a pretty deep, nasty, inflation-driven, interest rate escalating shakeout to the long-term 13-year plus bull trend. We don't know the answer to it yet, but we're working really hard every single day to figure out, to guide clients of the wealth management business, clients of the research and trading advisory business, trying to keep them and ourselves on the right side of it. I don't know if we have an answer yet. I don't think the future is written in this situation, but these are the kind of markets, as I said, you've got to uncover your short-term trading skills and analysis, capabilities, and stay on top of it, because I don't know. Guys, around the horn, is this the low? And if not, what's your gut? Does anybody want to step in front of this, or do we want to just say we're going to take it day by day?
My view is that correction is not done, but that's just based on a current macro frames. That can change pretty swiftly if we see a change of stance in a monetary narrative. But currently, I'm still looking for between 3,000 to 3,200 levels, and I consider still this the correction. So that's my personal view, looking all of these components, except a technical chart of the Nasdaq S&P, but that can be changed in a blink of an eye if we start to experience more cracks as we have seen in the UK. We have been discussed a couple of weeks before. So as these cracks are starting to appear, one of these cracks might actually force central banks to pivot very quickly.
To pivot. And I would say if contagion was really viewed as a risk that started with quantitative easing out of the UK, why are financial stocks leading? On the RRG work, I'm not sure if Terry mentioned it, but financials on the weekly are showing a lot of relative strength right now. A lot of it has to do with the shape of the yield curve. And that's the other thing that we help our clients do, trying to understand all the stuff that's been thrown out there on what the proper yield curve is. 10 versus the 2, 10 versus the 3-month, nominal yield curve, real yield curve. And as most equity investors, I would say 61.8% of equity traders and investors could give a crap about interest rates and yields, but hate to say it, you got to have somewhat of an idea of what it all means, because it's big time driving the stock market right now. And just to show you, like, this is one, I have longer term positions. I don't want to pay capital gains on, so I do have hedges. I've been working through this with clients. Got a butterfly on in the NASDAQ. Put it on a while back, and it's centered around 10,500. I kind of adjusted the option trade. It was about a $15,000 risk on the trade to make about $45,000, and I adjusted it with an options position. So now I only have about $3,000 of risk if we're above 11,000 in the NASDAQ on October 21st. And if we could stay around 10.5, which I doubt it'll be, it's a pretty good hedge, around $56,000 on that trade. But this is hedging longer term positions that I don't want to take profits on, and pay taxes on. We have other trades, we have shorts on in a couple of weak stocks. Ben and I have been working those as well. So we're taking it day by day. But I think important thing is if you're a little bit confused but interested, I would say good. That's right where we want you. So take the trial below. It should say I'm in. Is that correct, guys? I should right below the screen, I'm in. That will give you.
Yep, that's correct.
Okay. So I think it's a 14-day trial. You get full access to trading analysis services, including Terry's relative rotation, technical analysis of the market, looking at sector and industry and stock rotation, Bennett's Elliott Wave work on the indexes, and all the other work he puts in the Elliott Wave analysis of all the individual stocks. Alex has got crypto and macro very well covered. I'm starting to re-enter the fray, and I've got a couple tips and tricks and another dimension to add to trading analysis that will roll out in the new year in 2023. So there's a lot ahead, and I really don't see the markets going back into a real quiet sub 15 VIX boring environment anytime soon. I think it's going to stay busy. So active management on all time frames, short-term traders, long-term investors, I think it's important right now, especially people who are in their 50s and 60s and retirements on the horizon. It's important to be plugged in and with a group that's watching it as intensely as we are. So $7 trial. I think it's normally $47. Hit it below I'm in. And we have a lot of content coming up in the next 3 months to round out Q4 22. And as I said, we're coming up on our 10-year anniversary, entering our second decade of business. And we've got some fun things in store. So thanks for joining us. I know that was a way too long webinar. If you made it this far, I appreciate it. Guys, closing thoughts?
Good session. Thank you guys for sticking with us. Again, tradinganalysis.com. You can also check us out, obviously, on YouTube, youtube.com/tradinganalysis. We're live every Wednesday, also live every Thursday. And you can, of course, follow us on Twitter. We would encourage you to test drive our services. I do think that although the lows could technically be in, I'm not discounting that possibility. I think we're going to know over the next 2 to 3 weeks and certainly into the midterm. So excited about the potential on the horizon, and I do think it's going to come down to price structure and the indexes moving forward.
Well said. All right, guys. Thanks for all the great information. Thanks for the time, and listeners, appreciate you guys staying with us. I do. This is the first. Bennett, you're running these going forward. I quit.
Happy to run them.
Thanks,
Happy
guys.
to run them.
See you guys.
Have a good one. Take care.
See you guys.
All right.